Americans lose $246 billion every year because of knowledge gaps in their finances. For the average person, that is $1,000 gone annually, largely because they haven't quantified exactly where their money is going. In the next 5 minutes, we will identify the only 3 numbers you need to fix this: your net income, your expenses, and your net worth. To start, gather your prerequisites, open your banking apps, find your current loan balances, and pull up a blank spreadsheet or a piece of paper. You cannot manage what you do not measure. By the end of this exercise, you will have the coordinates required to move from financial drift to a planned direction. We begin with your net annual income. This isn't your salary before taxes. It is the specific amount of money that actually arrives in your bank account. If you receive a steady salary, take the final number on your most recent payslip and multiply it by 12. If you have variable earnings, look back at the last year of deposits. Total up everything from side hustles, freelance work, dividends, or rental income. Input these sources into a green section of your document. This total amount represents your true annual cash flow. This number is your ceiling. It is the absolute limit of the lifestyle you can fund right now without borrowing from your future. Now create a red column for your expenses. Start with the obvious recurring bills: rent or mortgage, utilities, transportation, and groceries. Most people fail at budgeting because they only think month to month. To find your true baseline, you must include irregular costs like car registration, annual subscriptions, and those small online purchases that add up over 12 months. Subtract your total yearly expenses from your total yearly income. This calculation reveals your surplus or your deficit. If the number is negative, you are in an income deficit. This means you are spending more than you earn, a process that actively destroys your wealth and creates debt. If the number is positive, that is your surplus. This is the money left over after your lifestyle is fully funded. While your income buys your current lifestyle, this surplus is the only tool that can buy your eventual financial freedom. Cash flow is only half the story. Now we calculate your net worth. We start with assets, everything you own that has concrete market value. List the balances in your savings and retirement accounts, the value of any real estate, and what you could sell your vehicles for today. Directly below those, list your liabilities. These are your debts: your mortgage balance, student loans, car loans, and any credit card debt. Subtract your total liabilities from your total assets. This final number is your total net worth. For many people, especially those early in their career or with significant debt, this number will be negative. Patiently. If your number is in the red, do not view it as a failure. It is simply a mathematical starting point. The goal of financial literacy is to ensure that your future decisions consistently push this specific number upward over time. By completing these calculations, you now have a snapshot of your financial health based on actual data rather than guesswork. If your math showed a surplus, your first priority is using that money to build a 3 to 6 month emergency fund in a high-yield account. This is your foundation. If you already have a cushion, direct that surplus toward your highest interest debt to stop the compounding interest from working against you. A high income with a low net worth is a trap. It forces you to keep working just to sustain your consumption. You now have the numbers required to make your first informed financial choice. To see how to apply these figures to get out of debt faster, subscribe and join us for the next lesson on the debt avalanche method.